Good day, everyone. My name is Rebecca Lilly with the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled Towards the Establishment of a Wholesale Electricity Market in South Africa. We're grateful to SAAEE, our moderator, Kay Walsh, discussant Ryan Hawthorne, and our speaker, Keith Bowen, for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues amongst professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services you can find at our website at iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speakers, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time to read and answer them. And now I'd like to introduce you to our moderator, Kay Walsh. Kay, over to you.
Thanks so much, Rebecca, and welcome everybody to today's webinar. I'm just briefly going to do an introduction representing the South African Association for Energy Economics. Was recently appointed as the association president, and just wanted to give a quick overview of who we are. We're a non-profit, non-partisan professional association that aims to provide an interdisciplinary forum for the exchange of ideas and issues among professionals interested in energy economics. We welcome anybody with an active interest in the field of energy economics, policy and regulation in South Africa, but also on the African continent more broadly. And yeah, we'd encourage you to join us if you enjoy this session. I also just want to briefly thank our institutional members for 2024. Without whom it would not have been possible to host this event. So thank you very much to Power Futures, Acacia Economics, and Nova Economics. Just in terms of SAAEE's broader is the local affiliate of the broader International Association for Energy Economics. And this is actually one of the largest associations of energy professionals in the world. We have more than 4,000 members representing 110 different countries. And SAAEE is one of the 30 plus local international affiliates of the International Association. Our largest affiliates are in the United States, Sweden, Germany, France, Italy, the UK, and Saudi Arabia. But we also have 3 African affiliates ourselves, Nigeria and Uganda. And then just briefly, what are the benefits of becoming a member? You have access to all the local conferences and events and webinars that we will be organizing. But you also have the opportunity to participate in the IAEE's international and regional conferences, which are held annually. And I just wanted to highlight 2, the upcoming 3rd Middle East and North Africa conference, which is taking place in Riyadh in Saudi Arabia. And that will be on the 8th and 9th of December this year. And then our next international conference as an association is in Paris from the 15th to the 18th of June next year. Becoming part of SAAEE also gives you access to 2 high-quality journals, which are illustrated on the right, and a robust lineup of webinars and podcasts hosted by the affiliates. But yeah, without further delay, I'd like to introduce the topic for the webinar today, which is towards the establishment of a wholesale electricity market. I think in many jurisdictions around the world, the main motivation for restructuring the electricity supply industry and indeed introducing wholesale electricity markets has been primarily to improve system reliability and efficiency. And this is done by enabling competition and private sector investment, and aims to reduce the risk of costly and/or overinvestment in capacity, which might be due to policy paralysis or political interference in a more traditional vertically integrated market. So as we transition as South Africa to a wholesale electricity market, it's important to bear in mind that it's a really complex process that requires due consideration of many factors, economic, technical, and regulatory. And yeah, we've invited Keith today because he's going to shed some light for us on some of the prerequisites, particularly around the areas of a well-defined market structure and wholesale electricity market design, and also around establishing clear rules, regulations, and market mechanisms. So without further delay, Keith, I'm going to stop sharing and I'd like to welcome you to join us.
Great. Thanks very much, Kay, and hi, everyone. So I'm just making sure that my screen is visible. Great. Kay, do please stop me if it's not visible or not progressing. So my name is Keith Bowen.
Thanks.
Great, thanks. I'm with the National Transmission Company South Africa. Many of you would have noticed that at the beginning of July, the transmission division was separated out as a subsidiary. So we now, from the Eskom transmission to now the National Transmission Company of South Africa, we're still a subsidiary of Eskom, but the idea is for us to start developing a lot of the mechanisms towards the unbundling and towards a competitive electricity market. What I will be speaking about today is the market model itself and the work that's being done around the market code. Some of you may have already attended our market code workshops. We have been running workshops since the beginning of May after we launched our draft market code in April. So a lot of what I'm going to talk about today is maybe not new, but the idea is to give a little bit of an introduction and the fundamentals of what we're talking about when we talk about the wholesale market model and how that might work going into the future. As part of the background is you understand that the Electricity Regulation Amendment Bill, which was passed by Parliament in May and is now awaiting the presidential signature, sets up the concept of a multi-market model. And this in itself is actually based on work 20 years ago. In 2003, the government then set up a consortium that looked at different models around the world and kind of brought people together from different jurisdictions as well as people locally to look at how a competitive electricity market would work. And this was arising from the Energy White Paper itself, published in 1998, which laid the foundation for a competitive market. And it was government's intention at the time to prepare for that competitive market. So a lot of work was done then. And the basis of the multi-market model, what we are presenting on now, the foundation was laid all the way back in 2003. My history with that is that at the time I was working for Eskom, we were seconded to the consortium to work on those rules. And so I kind of got to know quite in depth how those markets would function. And we actually started trying to implement them within Eskom at the time, getting ready for the market. But unfortunately, all that disappeared in 2004 with the change of government, at least with new ministers and a whole new direction. So pretty much disappeared off the agenda for 20 years and is now back in vogue. So we've resurrected a lot of the work that was done then, obviously having to take into consideration some significant changes, particularly in technology around renewable energy, storage, various components that actually question some of the things that we decided 20 years ago, and how would we make changes to the model to accommodate that. So hopefully during the course of this discussion, I'll highlight some of those items and we can then talk about what that means. So when we talk about the model, sorry, just trying to get to the model, because by its name, it suggests a multi-market model, which means that there are multiple platforms on which generators, consumers, traders, retailers can interact with one another in order to procure and produce or sell energy on a day-ahead basis, long-term basis, real-time basis. And the whole idea of the multi-market model is that it allows it, it's not a centralized pool, it's not a central market which clears for everybody. There are options available to participants to be able to deal with each other directly through physical bilaterals, obviously financial bilaterals, and we'll talk about some of those interesting implications during the course of this discussion. When in this picture, what I'm trying to talk about is the transmission system operator, the role of what is now the NTCSA, and potentially, as with the ERA Amendment Bill suggests, that we would be a totally separated state-owned enterprise called the Transmission System Operator, which is really a model used predominantly in Europe, where you combine the grid owner and operations with the system operator and create a transmission system operator. What we're doing in South Africa is a little bit different, is that we add the market operator and this entity called the Central Purchasing Agency as part of that overall structure. And that's built into the legislation and how we intend that the TSO should function once separated out. So historically, the network operator is not particularly anything new or different, but the important thing here is that the focus as a separate entity, that the transmission business really looks at how does it build the grid to be able to accommodate a market or accommodate new generation, new demand over time. You know, historically, transmission planning, you kind of knew what was being planned in terms of the generation capacity, and then you could build the lines to be able to accommodate that. Now you have to anticipate what a market might do and what competitive producers, generators, where they might choose to build their plant, and look into the future so that your grid prepares for this dynamic possibility rather than always having to play catch up after the fact. The system operator is also, we have the system operator currently within the Eskom transmission division. So the system operator is also not something particularly new, but once more, it has to deal with a dynamic environment, multiple buyers and sellers, generators, retailers, and trying to deal with that information flow on a daily basis, hourly basis, and having a good understanding of what's happening in the market. And so that role of the system operator is similar, just becomes a significant cornerstone for the future of the market as we progress. The market operator is new to South Africa at any rate. The market operator almost acts like a stock exchange. It's an exchange platform. It is not a buyer, it's not a seller, it takes no ownership of the energy, but it's providing the capability for buyers and sellers to be able to interact through a market platform. So, and I'll talk a little bit more detail about the day-ahead market, the day-ahead reserves, and intraday and balancing as I go through. But importantly, those are all physical platforms. They deal with the commitment to produce or consume energy, either on a day-ahead basis or an intraday basis, or even in real time. It involves with that we link a lot of the contracting and the buying and selling that happens on those platforms to a physical delivery in real time. Day-ahead reserves is obviously then looking at what the system operator requires in order to keep the system in balance during the day. So on the day ahead, it tries to procure certain resources that it will be able to dispatch as the system requires as we get closer and closer into real time. So that also, that commitment in terms of those reserves, those options, is heavily tied into what is decided in terms of the day-ahead energy market, because we co-optimize those. The proposal and what we've looked at for the model is that when a generator or even a demand response option submits a bid or an offer into the market, it has an energy component and obviously a capacity component. When it gets scheduled as part of the optimization process, there's a consideration for the reserves that are required by the system operator. So it's co-optimized with a constraint requiring a certain amount of reserves being applied, and tries to do a least cost optimization incorporating those constraints. And that's quite an important aspect of the day ahead process, to make sure that when the schedules come out and the system operator is able to take those schedules, we know that it's physically dispatchable, that physically that energy can be delivered. So it's heavily tied to the physical properties of generators, the network, to make sure that it's feasible in real time as well. The Central Purchasing Agency is the new sort of kid on the block when we talk about the development of this market. The Central Purchasing Agency has three very key roles in the way we see it. Firstly, it's trying to deal with the legacy IPP program. So you can see there on the graph, I talk about Section 34 IPPs, Independent Power Producers. These are procured under the existing government programs. So we've had bid windows 1 through to 6 under the Renewable IPP program. We've got the Risk Mitigation Program, the DOE peakers. and now that the storage program and potentially a gas program, all being procured through determination from the minister under Section 34 of the ERA. And the Central Purchasing Agency becomes the buyer under those contracts. So even as the market opens up, those participants, those IPPs don't become participants. They stay with their power purchase agreement. They're not impacted at all by what's actually going on in the market. But the Central Purchasing Agency then has to act as the sort of intermediary between what's happening within the PPA structure and what's happening in the market platform. And so therefore, when wind farm gives a prediction of what they're going to produce the following day, the Central Purchasing Agency basically offers that to the market and says, right, that's what we are going to be doing. And so it has to collate all of that information from the various IPPs and then makes that information available to the markets, that the market can schedule it as part of the day ahead process. It also means that the Central Purchasing Agency takes what we call balance responsibility for those commitments. So if it's got all those forecasts and it provides that information and it's taken into the market, the CPA then has to deal with the overs and unders if that generation doesn't actually materialize. So if the wind farm overpredicts and it's producing less, the CPA has to deal with what we call the balancing mechanism, the under delivery, and therefore has to purchase that energy from the market at the balancing prices. So that balance responsibility becomes quite an important aspect that the CPA also then has to manage through the course of its operation. Yeah, okay, sorry, I see your hands up.
Thanks, Keith. Yeah, I have firstly, Ntumba raised a question on the chat asking if there was any empirical evidence to support the idea that the creation of wholesale electricity markets does in fact improve system reliability and performance. So maybe if you could answer that. And then from me, just want to understand how, the role of the CPA in terms of the legacy contracts. Will it buy both energy and capacity from the legacy IPPs and from Eskom, or is it just the capacity?
Okay, I'll start with the first question. So the idea then is that with markets, there's no like empirical evidence. There's a lot of suggestion and the information that shows how markets provide for the dynamic pricing that is required for new generation, for the building and the efficient operation of capacity. Often markets do require that there's excess capacity in the system, otherwise the prices go to a very extreme level, but that in itself triggers the behavior in terms of building new capacity. For me, one of the biggest things is that it actually, what markets do very effectively is that you do de-risk the system so that not all your eggs are in one basket. So it's not a centrally planned where if the central planner gets it wrong, then everybody suffers as a consequence, as we well know. And so then the idea is that as consumers, you're able to make choices. There are multiple providers and therefore people will be building capacity for the market or for specific customers. That does mean that you de-risk a lot of the process because there are multiple providers in the process. In terms of that discussion about the Central Purchasing Agency, is that yes, when something is dispatchable, so let's talk about, for example, the DOE peakers, the risk mitigation program, there is a capacity component. So the Central Purchasing Agency is buying capacity as well as energy. Predominantly, though, and particularly for the renewable IPP program, it's an energy-only PPA. So the CPA will be offering the energy into the market. For the dispatchable generators, it will offer a price and an availability to the market, and the market will decide whether it needs that generation. So for particularly the peakers with an open cycle gas turbine, you'll be looking at the diesel rates, offering that into the market, and if the market takes it, then that helps set the price, and it is dispatched and generated based on what's offered into the market. So the CPA does, through the PPAs, have different kinds of structures, and each program has different structure as to how they purchase. But that is just for the Section 34s. The second role, which I haven't gone into yet, is that the potential for new capacity, that as the market unfolds, we expect or anticipate that consumers will be buying, and there will be retailers in the market and large power users who are making commitments on a longer term, and generators will be building to supply for that energy. But there could well be that there's a gap between the expected demand going over the next 5 to 10 years or beyond and what the market is actually providing on its own bat. And so there's a need for either building a capacity market which provides for longer term capacity signals for new generators, or going through and leaving it to the Central Purchasing Agency to go out on tender and run a procurement process for the backup capacity that we feel we might need for the market. Because it really is quite an important thing that the system operator needs to ensure that over a longer period of time, there is some certainty that they would be able to dispatch or operate to keep the lights on hour by hour. And if your entire system is really energy only, there's a high risk that you won't be able to deal with extreme events. And we've seen that in North America and to some extent in Europe, where you have energy only kind of environments that when something goes wrong, there's not sufficient capacity to be able to deal with the swings because a lot of the generators fall off for various reasons, or demand is higher than expected. The system can't actually accommodate that. Whereas in some of the regimes where you have capacity markets, and here I'm picking on PJM in the US, where they do have quite an effective sort of longer term capacity signal. They have a capacity market which operates on a regular basis. They can then set the signal for people to build the capacity. So yes, you do tend to get over capacity because you're setting an effective signal, but it does mean that the system can actually ride through specific events. So that's something that we would look at as to whether or not, and I must say my preference is that we build a capacity market with clear rules and we allow people to participate in that market. You can then set the signal for the longer term. But failing that, if we don't get a capacity market in place or an effective one, the Central Purchasing Agency would need to go out and procure to make sure that we build that capacity going into the future. The third role for the CPA is, as we'll talk about a little bit later, is dealing with the transition. So the idea is that the market will be in place, in the next couple of years, and there's not a firm date as yet. We're sort of working towards an assumption of April 2026. But even from that date onwards, for 5 years, we anticipate there being some sort of transition mechanism. And I'll talk a little bit more about the transition mechanism later. But the idea is then that the Central Purchasing Agency acts as an intermediary to manage what we call the vesting contracts, or the hedging agreements between generators upstream and consumers downstream, and then plays a role for that transition, managing those contracts, and then eventually those contracts wind down, so that at the end of the transition, the CPA has no role in that anymore either. So it does mean that the CPA has a limited shelf life to some extent, because it's dealing with a transition, which is meant to be 5 years, and as well as the Section 34 IPPs, which in themselves are a limited window. There's a power purchase agreement that, some of them are still being signed for 20 years, but at the end of the 20 years, then it's kind of, now what? But the idea is that if they are still procuring, if they're there as the sort of backup supplier, making sure that the generators are being built, they may have a longer term view. But in reality, the main focus for the CPA, at least in the short term, over the next 5 to 10 years, or the two roles, is the vesting contracts, and then also dealing with the difference in prices between the Section 34 IPPs and the market. Because the CPA is buying from the Section 34 IPPs at the power purchase agreement prices, that's quite different from what the market is willing to pay for that energy, and that difference is going to be covered by the Central Purchasing Agency and potentially recovered from consumers through a legacy charge, which I'll also talk about a little bit later. Quite importantly, yes, Kay.
Thanks so much, Keith. That's really interesting. There's another question from Ntumba, which I think is related to this question of what happens if there isn't a capacity market. But when other systems or countries have transitioned from vertically integrated utilities, which has, I think, been happening since the sort of 70s and 80s, to multi-modal markets or just wholesale markets, what are some of the unintended consequences that have emerged? And what will South Africa hopefully have learned from that?
I think one of the, it's not, I'm not sure if it can say it's unintended, because it's a clear, we can see it happening, and we probably would have been able to see it happen, is the need for flexibility. That as markets are in themselves quite volatile, the market moves around quite a bit from day to day, hour to hour, the type of generation that does well in a market environment is very flexible generation. So big base load generators struggle with where prices shift from day to day, unless they have longer term contracts for differences, or sort of hedging arrangements which guarantee them revenue. They really do struggle in an environment where the pricing moves around quite significantly. So you had seen that particularly when the market sort of opened in Europe and to some extent in North America, and we're seeing that even more recently, we tend to then move away from coal towards gas as a generation, because it's more flexible and it can accommodate the changes in pricing. If we're seeing a lot of renewable plant coming into the grid, and we would obviously expect that for various reasons, including sort of a decarbonization agenda, but just also because of the cheaper energy price associated with those, it means that there will be volatility around the prices, because in some hours you might have an excess of energy and in others you would have a shortage. So you would see quite big swings between an off-peak and a peak price, and really gas is well suited for that sort of volatility, to be able to provide that. Alternatively, also storage, but of course there's always a big thing as to how effective storage would be over a longer period than a day. But the point is that these are the consequences really of introducing this kind of market, is the need for flexibility. And that even a baseload generator, they can cope with the market. As I said, you can do CFDs, but their consumers, the people who are kind of backing up the CFDs, always have that issue where they're having to compare what they're paying under a longer term CFD to what's happening in the market. And there's a certain amount, let's call it like buyer's remorse, when if the market prices are dropping to zero, if not going negative, and you've hedged for a long time for 50 cents or whatever, there's definitely a risk around that. But importantly, markets do like the flexibility. Then I hope that's answered. Then just moving on to this concept of the physical bilaterals. So as I mentioned, the idea is that while we have these market platforms, and they are predominantly centralized through a market operator that is providing the platforms for people to trade, the day ahead is not mandatory. The day ahead market is purely voluntary. People can choose to participate in the market. The idea is that the balancing mechanism is mandatory. Everybody has to commit to what they're going to produce or consume the following day, declare that to the market operator. So even if you've got people who are not participating on the day ahead or the intraday, and they're operating on a physical bilateral, they must declare day ahead what it is that they're going to do, so that the system operators and the market operator are able to plan around them and schedule around them, so that the system operator has a good understanding of where the energy is flowing from. And two, particularly as we consider network constraints in the process, where you have to understand the flows across the network, it's really important that the physical bilaterals are declaring day ahead what they're likely to do, whether in terms of generation or consumption. It then means that they become what we call balanced responsible parties, that after the fact, we go and measure what they did do versus what they had declared, and they are exposed to the balancing mechanism to deal with the overs and unders in terms of what was expected on that day that they declared day ahead. So it does mean that market participants can do longer term contracts through physical bilaterals. They can also do longer term contracts through financial bilaterals. So as a wind generator, obviously if I'm developing the wind generation and I want to go and get the funding for that, mostly you have to prove that you've got a long-term commitment from an off-taker in order to get that funding. And at the moment, because we don't have a market mechanism, most of that is done through long-term power purchase agreements, physical delivery agreements. So as a wind farm, I will commit to produce, and I've got a customer who's committing to purchase that energy, and it requires physical delivery and consumption on an hour-by-hour basis. And that is the cornerstone right now for our wheeling framework that we have, and we're seeing a lot of that developing over time. The alternative is to do a contracts for difference or a financial bilateral, where as a wind farm, I can sell into the market, customers will buy in the market, but I have a counterparty for a financial bilateral, which guarantees a revenue. As I said, so you can have your contracts for difference, where as the prices move up or down, I can make sure that if I've over-earned in the market relative to my contract for difference, I would pay back to get back to the strike price. Similarly, if I've under-earned, if my revenue through the market is lower than my contract for difference, I will receive from the customer the make-up price. And those both give that long-term price signal, the long-term certainty, but the benefit, at least from my perspective, the benefit of the going through the market and having a CFD is that a lot of the physical risks are removed from the daily operation of the facility. So right now, all the PPAs that are being signed have to deal with the fact that the network operator may curtail the generator or may not be able to deliver all the energy. And as a generator, I have to have that covered by someone, and it's going to be the off-taker. Or it might be insurance, but at this stage, it's pretty much off-takers have to provide some sort of certainty around that. When we do load shedding, the customer may not be able to consume all the energy that is being produced by that generator. So those sort of physical risks have to be built into the PPA and anticipate a lot of things that could happen, which would impact the physical production or consumption by the parties. Whereas if you're going through the market takes care of a lot of those things. We build in rules around curtailment. If a wind farm is scheduled to generate and then there's a real-time problem or even a day-ahead constraint, they get compensated by the market for having to move themselves away from their optimal position. And that then means that you can have your physical risks managed in the market, and the financial is just handled outside and a little bit less problematic for the parties into the future. But that's in a nutshell sort of the concept of the model. What I'm going to do now is talk a little bit more about the code and some of the detailed aspects. So also, again, please feel free to ask questions as we go through the process. The Electricity Regulation Amendment Bill, as it stands, requires that the market operator, as I said, which is now part of the NTCSA, to develop a market code and provide that market code and ensure in the market code certain conditions are met and criteria built into the ERA Amendment Bill. Here we just really focus on a couple of the key roles and responsibilities that the market has. So there's the market operator, the system operator, the regulator, and the different roles they have, as well as the different market participants. As I mentioned, we sort of have a bit of a hierarchy. You've got a balanced responsible party, which at this stage, it's any generator over, I think it was 10 megawatts, that has to, they have to be balanced responsible, so that they declare what they're doing, even if they're not going through the market. And technically, any retailer or a distributor or trader is also balanced responsible. So they can interact through physical bilaterals, but they have to declare those to the market operator every day. We then have a market participant, and the market participant then engages in the day-ahead market, the intraday, day-ahead reserves, and they're proper market participants, and they have rules and obligations around that, and that's included in the code. We have a number of processes. I'm not going to go into great detail on that now, but it's around how we add the new participants, how we deal with disputes, and how we actually change the rules themselves, and managing the rule process, which obviously has to allow for a certain amount of flexibility itself to deal with changes in dynamics in the market, as we mentioned earlier, some of the unintended consequences, as well as changes in technology. I mean, as different technologies come on, we may need to have specific rules that deal with the different dynamics that might play out in the market. The products, I'm going to go into a little bit detail now about some of those products that are in the market, and as well as the timelines. Our proposal for the market code is it still operates on a monthly basis, mostly in the electricity sector at the moment. We're all used to getting monthly bills, and between the various participants, everything's done at month end, whether it's a billing period or a calendar month. And we would then stick to a calendar month, but we have daily processes. It's just the actual transactions take place at the end of the calendar month to deal with changes during the course of the month. So when we look at some of the platforms that we're talking about, the idea, as I said, we have a day-ahead energy market, a day-ahead reserve market, which are very much linked in terms of how we optimize those when we do the schedules on a day-ahead basis. We then have an intraday, and the intraday is really for those who've taken positions, whether market participants or physical bilaterals, for them to be able to adjust those positions. And the reality here is that day ahead, if we're closing, all the bids and offers have to be in at 10 o'clock today for tomorrow. Between then and the real time tomorrow, there's a lot of opportunity for change. Things will shift. Wind is different. Solar radiation may be different. Demand is different. A generator, whether it's a thermal or otherwise, might find the availability changes. Those sort of things are quite significant, and that should then be updated as part of the intraday to make sure that as we get closer and closer to real time, there's less need for the system operator to make the changes, that they would be able to accommodate a small amount of changes because it's mostly been covered through the intraday market. But the balancing mechanism is there to deal with the fact that the system operator has had to dispatch different generators, bring in demand response to be able to deal with imbalances, because that's its main focus, is keeping the frequency at 50 hertz. It's managing supply and demand on a second-by-second basis, and any of that variation would have to be dealt with under the balancing mechanism. We talked about the capacity market as a potential into the future. At this stage, we haven't written rules around the capacity market, but we are looking as part of our first iteration to see if there's something that we can develop by the end of the year that might be the foundation for a future capacity market. So that we're providing the signals for long-term as well as the short-term sort of energy market mechanism. There are also ancillary services. So right now, most of that is covered under the grid code. So the market code doesn't really spend a lot of time other than dealing with the reserves, which is technically an ancillary service, but it's more dynamically traded. A lot of the other ancillary services would be sort of longer term contracts. So it's system restoration, it's voltage regulation and synchronous condenser operation, potentially also the capability for inertia services. Those things might be longer term and require longer term contracting and not really covered that well under the dynamic processes built into the market code. We also look at sort of other services as we develop these codes. Would see that maybe forecasting, balancing as a service, metering as a service becomes quite an important aspect that we have to take consideration of and potentially build rules for over time. So I'm going to spend then a little bit of time on the details. I'm just trying to make sure that that the graph is visible. The main picture here in terms of the day ahead is trying to match supply and demand, and obviously we're energy economists in the room. That it's very clear the sort of generic view of how supply curves are built and how demand curves are built. But here, the whole idea is that particularly the supply curve, you've got a group of generators, a whole lot of generators, all offering their incremental cost of production and saying, you know, there are obviously technical parameters between their minimum generation point, maximum continuous rating. What is the cost in each of those increments for me to be able to supply at that point? And also looking at a slightly different way, as the price increases, would I want to increase my generation to be able to accommodate that? So we're able to build up a supply curve based on these offers from the various generators. The demand side is a little bit harder, but here the idea is that most demand customers, as large power users, retailers, would give forecasts of what their expected demand is going to be built, knowing various conditions on their plant, amongst their customers, looking at it per hour, what the demand is going to look like. But some of them might be able to offer a price responsiveness to say, if the price rises above a certain level, I will either reduce consumption or switch to my own generation capability. So if you think about, maybe a large power user might have their own generation capacity, but it might be quite expensive. They would rather buy in the market until the price gets to a certain level and then fire up their own generators. But there's also the possibility of demand response products, a pure demand response, like a smelter, being able to interrupt for up to 2 hours and offer that into the market. And by doing that, they're able to influence price. As you can see on this graph, the theory being that when we have the different generators, you get to a point where if we don't have any demand response, we might schedule supply at the maximum price and the maximum bid. But if there is some demand response, we can actually drop that. And obviously the quantity supplied and demanded drops accordingly because now there's a withdrawal of demand. But similarly, then the price would also drop. And that, you see a certain amount of consumer surplus and producer surplus, and it's really about the rebalancing between those different participants in the market to ensure that demand response, who might actually respond anyway because they're going to reduce consumption if the price gets too high, gets an opportunity to set the price and participate in that price discovery to ensure that we know that they're likely to respond and that therefore the lower price would be more effective for everyone. But that's essentially the day ahead. What happens at day ahead then is that we have what we call the unconstrained schedule, which is really this meeting of supply and demand. We do take into consideration the technical parameters of each of the power stations. That's one of the dynamics of our multi-market model. So unlike Europe, which generally tends to just look at supply and demand every hour, almost treated independently, so that you know what the schedule would look like. What we do is that we take into consideration that some of our thermal generators, and it may even be that for some of our demand side, that there's got to be ramping considerations and minimum run times, minimum off times, those sort of technical parameters that mean that each hour is not independent of the hour before or after it, that they have to be sort of co-optimized as well. So we build the process where we take in some of those technical parameters, a little bit more like the American style for markets, and then optimize over the whole day. The idea, we also then optimize 6 days in advance because we want to make sure that, particularly for the pump storage cycle, that we are managing optimization over a longer period of time. And that essentially means that in each hour, there might well be other players that probably would have been more sort of cheaper, but because of these technical limitations or parameters dealing with the sort of long-term picture or the larger term picture, they're just not scheduled. So for example, if I think about, you might have the option of scheduling for 24 hours a coal power station at around a kilowatt hour, or you can run a diesel generator for 2 hours at 7 Rand a kilowatt hour. If you're doing the least cost model, you would then choose to run the diesel generators for those 2 hours and not schedule the coal power station. But if you were looking at it hour by hour, obviously the coal power station as the cheaper generator would be picked for at least for the peaks. But then you have the issue that they now have a minimum run time, which would make them probably less efficient for the other hours. So that's the whole idea of trying to do this through a centralized mechanism to try and deal with the least cost, but also take into consideration the supply and demand picture in each hour at the same time. That's the unconstrained schedule. So the outcome of that just looks at those sort of supply and demand issues with some of the technical parameters. We then look at creating what we call a constraint schedule. And the idea of the constraint schedule is then you bring in the network constraints. It's entirely possible that we would take, at least at the transmission level, you can do an entire really complicated load flow sort of analysis and bring that into the dispatch decision. And then there's a revisit to look at where there are constraints in the network. You adjust supply and demand in different places. Or you can do a more simplified nodal kind of system where you don't look at the entire transmission grid, but you really simplify that in order to make the runtime for your optimization a little bit simpler and more efficient. And our biggest concern is also going to be that over time, most of the generation in this country is really going to be in the distribution network. And obviously, a lot of the consumption is in the distribution network. If you have to then factor in the distribution network constraints, you really do need to model those at quite a high level so that your optimization can execute timeously, but you capture some of those conditions as much as possible to ensure that in real time, you're not suddenly introducing new dynamics, which means that there's an over and under. We try and capture those into the day ahead so that the outcome of the day ahead is fully implementable. So then that's what we call the constraint schedule. The idea is that the constraint schedule then goes through to the system operator, and they would make sure that the system is operating according to that. As I said, so from the day-ahead market and the physical bilaterals, we would have all these different declarations. So kind of as a simplification, I've shown here on the left-hand side, we have a whole lot of generators running from the cheapest to the most expensive, and each of them have been scheduled to a certain level, certain megawatts per power station. Similarly, on the right, we have large power users, one of which has its own generation capability. And then we also have some retailers that would have maybe some generation capability as well as some demand response. And all of them have participated in the market, or they've done physical bilaterals at the end of the day-ahead allocation, so which would be sort of by 2 o'clock every day. We have an indication per power station, and particularly the way we're doing it will be per power station unit. If the units are above 450 megawatts, the idea is that we then know how that's going to be dispatched and how it will be operated in real time as we get closer and closer to the real-time operation. What's important then is that, as I said, we have these intraday auctions, and the idea is that our intraday, instead of being one of the options is doing continuous trading, and under the continuous trading model, everyone can go and look and they can say, look, I need another 100 megawatts, or someone can say, I've got 50 megawatts to offer because my conditions have changed. And you can basically select each other, almost like an open cry kind of system. What we're saying is that potentially to avoid everybody having to have 24-hour operations, we would then look at regular auctions. So every 6 hours, people can, during that period, people can adjust their position. So if I've got a wind farm and I said I was going to produce 100 megawatts, but now I know the wind is not producing as much as I thought it was, or my forecast is adjusted, I can only do 90. I can adjust my position, and then at the next auction, that would be rescheduled. My 10 megawatts will be made up by someone else. I would have to pay for that as the generator, but I've given my changes of updated my dynamics, and now we allow the auction to go and reschedule for each hour for the remainder of the day. And so what that means is that you're going to have some generators who can back themselves up. So in this particular example, I've got a generator that's tripped and another unit has picked up to replace it. Here we've got a generator that offered an additional 100 megawatt, some customers who needed additional energy. One that needed a 50 megawatt, another needed 100, but then one that was able to use their own generation, they offered that up at the right price. They were able to then reduce their consumption by 50 megawatts because they're producing for their own purposes. So there's a rebalancing that would take place as part of that intraday auction. And what that's doing is it's essentially just providing better information to the system operator. So it's updating, allowing for the system to rebalance and deal with the constraints on the grid, and making sure that as we get closer and closer to real time, most of those variations are covered before the system operator has to kick in. There's also then the balancing mechanism. And as I said, the balancing mechanism is really trying to true up between what was supposed to happen, both between the day ahead and the intraday, versus what actually happened. And so what, as the market operator, we would provide to the system operator the bids and offers. It's quite an important thing that the bids and offers in the day ahead automatically go through to the intraday and automatically through to the balancing mechanism after, obviously, individual participants have been able to adjust based on the latest information. But we always allow that the price would carry on through. There's no ability to adjust price. The only thing that participants can adjust is the volume. So their volumes can adjust based on better information that they might have had. And what then the market operator is able to provide to the system operator, what we call sort of a balancing stack or a merit order, which indicates additional capacity that the system operator can call on in real time. And here we've kind of got them in their various increments. So there's the price at 400 Rand, 500 Rand, 600 Rand a megawatt hour, and then the volume associated with that particular increment. Similarly, we do one in the downward direction where generators are asked to back off, or potentially you might have some consumers, particularly if there's batteries involved or something, where you can actually pick up their consumption. But mostly we deal with generators backing off. And the idea is that we provide that information after the fact. Once we've determined, we've gone and picked up metering from all the various market participants, we can then decide where the imbalances are between what people said they were going to do versus what they actually did, and then determine those that cause the imbalance, in which direction do we then have to adjust the price? In our model that we've proposed, we have what we call a two-price balancing mechanism, where there's a price for movement in an upward direction and a price for movement in a downward direction. That's a choice. You can do it, and a lot of parts of Europe do it, where the price moves only in one direction. So if the net effect is an increase in generation, you move only in that direction. If the net effect is a reduction, you move only in that direction and set one price for the hour. Our mechanism is that we set it in both directions to provide the incentive on participants to always provide their best information day ahead. So even if they're lucky that they, the system is actually blowing in their favor, that, if they were dumping energy, there would still be a discount for that energy, even though the system actually wanted it, because by not giving the best information at the time, we may have had a suboptimal optimization on the day ahead. So our concept is that you kind of provide a signal in both directions for those who didn't follow the system operator's instruction. When we do the pricing, so on the day ahead, I didn't touch on that, the day ahead works on a marginal pricing mechanism, so that when you now meet supply and demand, there's one price that applies for everyone based on the marginal generator. But on the intraday and on the balancing mechanism, we look at a weighted average of the prices. So if there was an issue on the system and the price and there was an additional 500 megawatts required, then we do a weighted average of the merit order going up. Rather than setting the price at the highest, you then do a weighted average, so it comes out at a lower price for the system. The logic behind that is that if we did the marginal price, there is the risk that you kind of then incentivize generators or participants to back themselves up, rather than allowing the system to back them up more efficiently and pooling the resources across the grid. So if the prices were being set by the marginal generator, and let's say we were running diesel for 3 hours, if we allowed that diesel price to set the balancing price for everybody, you kind of partly you bankrupt everyone in seconds. But the real problem is that to try and avoid that outcome, everyone backs themselves up. So you find you're building way too much storage, or participants are not offering everything that they have available into the market. So therefore the market is clearing at a much higher price than what it needs to do, because everyone's backing themselves up in the system, and that's an inefficient outcome. So our proposal was that we do the weighted average, so that you still provide the signal without it being inherently punitive for everyone who's caused the imbalance. In doing the weighted average, our concept is that we would then pick up, we assume as part of the price setting that the system operator has perfect knowledge and is able to dispatch and has the time to dispatch strictly according to the merit order. So it would then run the first increment for its full 200 megawatts before the next one at 100 and the next one at 200. And so your weighted average is just assuming that we're using it strictly according to merit order. In reality, system operator can't do that. The system operator, because of ramping considerations, might instruct a whole lot of generators to pick up. It would issue new instructions across the board, and you might find that you're actually running a more expensive generator for 10 minutes in order to get the system back into balance before backing them off. And so that price would then be more expensive. The system operator would pay that. So they pay the as bid for the ones that responded to the signal, but you don't necessarily build that into the price to everybody. So there's a little bit of an over and under situation that takes place every hour based on the calculation of the balancing mechanism. So then I'm just going to jump a little bit into the vesting contracts. I'm leaving time for us to kind of have more Q&A, but I think it's quite important then to, as I said, we talk about the ideas that the market might open, and again, there's still a lot of variables around this, but sort of our planning is around potentially the market opening in April 2026, and that there's a 5-year transition, and in that transition, you build investing contracts, which is essentially a contract for difference, a risk management mechanism with the generators upstream. And at the moment, under the ERA Amendment Bill, it's basically licensed distributors downstream who are market participants. They would then be able to get vesting contracts. The idea of the vesting contract is then you also ensure that During that transition, as we go from a regulated phase into a full market phase, there's some regulation still for what the generators are allowed to receive in terms of their price, both a capacity price and an energy price, and some regulation then to customers, at least retailers, as to what they would pay for their energy and are then able to recover from their customers as part of the regulated retail price. So that regulated wholesale price would still then be there for that 5 years. What's potentially likely to happen, what we've proposed, is that the volumes associated with the hedge would reduce gradually during that period, so that both the generators, retailers start being more exposed to the market prices, and then learn to hedge with one another. So that you start doing the more longer term hedging directly and not necessarily through the central purchasing agency, who's the counterparty for those vesting contracts. There is the possibility that some generators, and particularly the Section 34s, as I mentioned, they would have what we call the long-term vesting contracts. So the PPAs that are already in place, those continue till end of life for at least for the 20 years of the PPA. But it's also theoretically possible that maybe some of the Eskom generators might also have a longer-term vesting contract to deal with the possibility of them being stranded in a future competitive market. And here again, just talking theoretically, potentially, if you think about Medupi, Kusile as the newer generators, having quite a significant overhead in terms of their long-term, their capacity costs and what they have to recover to pay for the capacity that was built, that may not be a feasible solution in the market. They may not be able to recover their full costs. So it could be that you build in a longer-term vesting contract for them, that whatever they've over recovered on the energy side essentially can be then used to offset the under recovery on the capacity, and similar sort of concepts, looking at how this might work once the market is fully operational. The timing for the 5 years is, we've proposed under the market code that it's a 5-year kind of window, but also allowing that at some point the regulator may look at it and decide whether or not it's concerned about market power. And not to beat around the bush. I mean, we have at this stage, Eskom generation as a single entity, exercising significant market power, being able to exercise market power, and then distribution as the bulk supplier, being able to also exercise certain market power. And you have to then manage that as part of the opening up of the market to ensure that once those vesting contracts are done, the exercise of market power is severely limited, potentially by either having lots of other capacity that is competitive, but also looking at potential horizontal unbundling of the Eskom fleet to make sure that they compete with one another more effectively. So that's something that during the course of that 5 years, we would have to be monitoring, and the regulator looking at whether or not we extend the transition period or look at other structural remedies that might be needed in order to ensure that when the market is fully opened, that consumers are not at risk from abuse of market power. So again, just to highlight a little bit sort of the concept of the contract for difference. So the contracts for differences really work as a hedging mechanism, and so that as we have volatile market prices, we're able to, between a willing buyer and a willing seller, be able to come back to an agreed price. And as I mentioned previously, the idea that a baseload coal power station could theoretically match up with a customer which wants baseload power and wants to guarantee its costs over the long term. So they would be market participants. They would offer and sell into the market, earn market prices, pay market prices from a consumer perspective, but then be able to hedge with one another to guarantee that over time, the generator gets the revenue it requires to be able to maintain its operation, and that the customer has protected itself against market volatility. Those are always the strong possibilities. And even in Europe, which has quite volatile and well-functioning markets, most participants are hedged, particularly retailers, because they don't want to be the ones caught with a regulated retail price and wholesale price that's going all over the show. They pretty much try and hedge themselves. We saw that when there was the price crisis in Europe about 18 months to 2 years ago, that as the wholesale prices went through the roof, those retailers that were fully exposed ended up actually going bankrupt, and then their customers are now having to go and find new suppliers. It was problematic for the market, and there's a risk to the whole system if there's not sufficient hedging being taking place. So it is one of our concerns that as we go into the market, how to kind of encourage hedging, either through creating standardized products that can be used by market participants, or encouraging that maybe the JSE or other platforms make sure that they provide for efficient hedging mechanisms to make it easy for market participants to be able to hedge with one another. Then just like as a sort of a last kind of parting shot on the concept of what happens as we get closer and closer into the competitive market, this need for an unbundled tariff at both a wholesale and a retail level. And the thinking, at least from our side, is that as the market becomes more competitive, then the energy price, we would have to firstly unbundle it, but it also might become a much smaller component of the entire value chain of the electricity sector. We've got the use of system charges, which pays for the network charges. We have those currently, but those might adjust as we're building new capacity from the networks to be able to accommodate the new generation. We also see that ancillary services, which are currently part of use of system charges, would change quite significantly. I think as we're seeing, particularly with increase in renewable generation, the backup required, the kind of reserves that we would need, as well as synchronous condenser operation and inertia, as well as and other services, might see that the ancillary services component of the tariff would also increase to accommodate for that. We then also suggest like a legacy charge. So as I mentioned, the Central Purchasing Agency has to deal with the fact that there are legacy costs associated with the renewable IPP program, as well as the other IPP costs that it has to pay under the PPA rates, but will only be able to earn revenue under the market rates. And assuming that that difference continues, at least for the next 5 to 10 years for bid windows 1 and 2, the CPA would have to recover that cost through a legacy charge, which is then applicable to all the market participants, even as they exercise their choices in a competitive market, that this overhang of the sort of the transition process, you have to recover that as part of a legacy charge. We've also considered that you might need subsidy charges or subsidy collection. Right now, the retailers, particularly just Eskom distribution, the municipalities, are able to cross-subsidize between various customer groups through charging subsidies, both inherently and implicitly and explicitly. That we might need to look at, as consumers are exercising choices and going through the market, whether through physical bilaterals or directly through the day-ahead market, there are the subsidies that will still be required. We can have the discussion that it should be done through the fiscus, and you can have debates as to the best place for which subsidies should be managed. But the reality is that at least for some period, there would need to be some contribution to subsidies, and so a national subsidy framework is quite critical, but would be part of a future wholesale tariff for market participants. As I said, the energy market would drive the pricing for most of the energy component of the tariff, and even potentially the capacity component of the tariff being managed through the market as well. But at least for some time, it would be recoverable from the Central Purchasing Agency having to recover for the capacity that is being purchased for backup for the electricity supply industry. So when we go into this transition and we sort of looking at this, the structure for the transitional phase is more than likely that wholesale tariff structure would be applicable and deal with a lot of these transitional processes and that. So that's kind of my presentation, and we can spend then time going through questions. Thanks.
Thanks very much, Keith, for the presentation. That's great. We have another question from Timber, and their question is, given RSA's social context with lots of poverty and inequality, how should the market-based system, what mechanism should the market-based system have to adequately address concerns relating to affordability, particularly for vulnerable populations?
Yeah, I mean, it's a great, and that's the concept of the subsidy framework. Right now, within the distributors, there's a serious issue around subsidies as consumers are starting to exercise choice, whether it be rooftop PV or going through wheeling contracts with private generators. There's a big risk that the retailers aren't able to subsidize and manage the special pricing kind of mechanisms that they have in place for indigent households. So we do need to look seriously at the idea that as consumers are exercising their choice, we're still able to ensure that there's a contribution. It can be done through the fiscus. It can be done as a social network kind of process that the fiscus deals with those shortfalls. But in the absence of that, and given that our fiscal arrangements are kind of pretty tight as it is, it may well be that for some time at least the electricity price has to accommodate for that subsidy framework. The markets are very good at managing efficiency around ensuring that the right generator is producing and that we're building the right kind of generation. But sometimes there are going to be real distributive issues around who's able to afford the prices, and the subsidy framework is probably the best to deal with those risks in our current environment.
I see that the subsidy is attracting some attention. So we've got a follow-up question from Ruz Moleshe, who would like to know, are there any countries that have examples of this kind of subsidy approach?
Yeah, I think definitely even in Europe and North America and other developing countries that have gone through this sort of transition, there's always a kind of a component sometimes done as a tax. And so you would find that even in some consumers where they are sort of residential consumers or retail consumers, contributing both for the transitional costs, so the cost of going through the process and dealing with the upheavals that transition manages, but also dealing with the subsidies. So, and those can be, as I said, part of it can be a tax directly to the fiscus or just a surcharge that is added to everyone's bills to be able to deal with those. So we're not alone. It's been done in many, many places, but the idea is the structure of it might be different. If we think about, for example, in Germany, particularly with the rollout of the renewable program, there was quite a significant surcharge added to households to pay for all of that. Most consumers ended up paying, but there was always those that were exempted. But the idea is that subsidy frameworks are not new. It's just trying to get the most efficient way in which trying to collect it.
And then I'm sure you can see Stephen Labson's comment. He's got a question about with the roadmap published 5 years ago, is there any appetite to roll out a transitional stage? I think you did explain the transitional stage, but Stephen's sort of asking about whether you could have bulk supply tariffs, vesting contracts, and that could be completed within a year or less.
I'm trying to make sure I understand the context of the question. So the most important thing is that the roadmap that was published by the Department of Public Enterprises in 2019 really looked more towards the transmission entity, which it was called, what we now call the NTCSA, as predominantly a single buyer. I mean, it was kind of the roadmap tried to think of, that it would be buying from everyone and selling to everyone. And it's only over time that we sort of started really focusing on the fact that a single buyer is not an efficient outcome, particularly if the Treasury is not willing to back up the single buyer for all the purchases that would be required. So, the market mechanism, although it's introduced in the roadmap as a potential, was not actually the envisaged sort of outcome in terms of the roadmap. What we've done now through the ERA amendment bill is if you're kind of stepping a little bit outside the original sort of concept of the roadmap and looking at the wholesale market with a more effective way of trying to ensure additional generation. When we look at that transition mechanism, it is possible that the transition mechanism can be built very quickly. I mean, because we're dealing with unbundled tariffs, trying to manage risk upstream and downstream. The ERA amendment bill at this stage does say, though, that market participants are not will not be, other than the retailers or the licensed distributors, would not be allowed to have a vesting contract. It's kind of the way the ERA amendment bill is written, is that vesting contracts are only applicable to Eskom generation and licensed distributors. So we kind of always thought that it's a possibility that large power users might also have a vesting contract. That's not how it's written in the ERA Amendment Bill, and then those participants would be looking at alternative pricing mechanisms other than if they want to hedge against market risk.
Okay, great. Unless there are any more questions, I have a question. Kay, are we out of time, or can I ask a question?
Oh, we said it was till 2:30, so you can fire away.
Okay, super. Okay, great. Okay, there's a question from Timber. Okay, so with market-based systems, there's always a risk of underinvestment in capacity. Recall the abandoned refits 2 decades ago. Would market participants be given any incentives to invest in long-term infrastructure? Is the question.
Yeah, well, that was the concept about the capacity market, but also just to talk about refit, because the whole idea is that refit barely got any chance to actually get off the ground before it was replaced by the renewable IPP program, because there was a fight over the regulatory rights to be that the regulator could set and regulate prices. So yeah, I'm not sure that refit was really the best example, because a lot of people's projects started developing based on refit, and when they did the first round for the renewable IPP program, a lot of those projects that had actually been planning to use refit were ready to be able to go into bid window 1, because bid window 1 actually had the maximum price was the refit price. So I'm not just sure you can say that refit kind of wasn't successful. It actually was. Just wasn't given an opportunity to really lead to the new capacity. I think there's always the risk that when you have a dynamic market price, that it's not a sufficient signal for new capacity. And you can have the debate as to how often would we see merchant plant being built purely for those prices. My experience of that is that, seeing what's happening in terms of the Southern African power pool, because don't forget, outside the domestic market, there's also the Southern African power pool, which does have a dynamic price setting mechanism. Historically, it hasn't really led to a lot of generation, but it's starting to, people are looking to build new capacity purely to sell on the Southern African power pool, and not with CFDs or other hedging mechanisms, but to actually, trade on a dynamic price. So I think it's possible that we can actually see some capacity, but yes, there is always the risk that it would be under, what we need, and you have boom and bust kind of price cycles. So what we would ideally look at is having a capacity market that sets the longer term price for this. And this is one of the deviations when we talked about what we had decided in 2003 versus what we're looking at now. In 2003, it was decided we didn't need a capacity market, because long-term energy price signals through long-term CFD contracts would be sufficient to encourage new capacity. Right now, with prevalence of renewable IPPs, I think capacity has a slightly different meaning. It's not about being able to produce energy over the long term, but ensuring that the system has the capacity when it needs it, and that there's some dispatchable capacity available to meet the system requirements. So it's quite a different kind of sense. So that's why we say that capacity markets probably have a much more important value now than what they might have 20 years ago, when long-term energy prices would have been sufficient. And Europe's seeing the same thing now. I mean, Europe also predominantly historically didn't have capacity markets. You had some capacity payment mechanisms, but generally not a capacity market. And now they're starting to look at, is there time now to start looking at pretty effective signals for new capacity to be able to keep the system in balance over time.
Okay, great. All right, if I may ask my question for just a moment, I'm interested to know about the status quo. So as I understand it, there's some precursors that you've put in place at the NTCSA regarding such as the emergency generation program, the standard offer. There is an existing internal market. Can you tell us a little bit about how things are going currently, as it were, in your current sort of market structures?
Yeah.
And in particular, how are prices evolving, particularly with the current ending of load shedding and so on? Thanks.
Yeah.
I hope that's not too.
So internally, we started the trading again in October 2019. As I said, we had this process in 2003 where we internalized a lot of the multi-market model, kind of worked internally. Between 1996 and 2004, Eskom ran what we call the Eskom Power Pool. It was an internal power market, and in the environment that we were in, which was excess capacity, there was a lot of competition between the power stations. Initially, the power stations were treated as individual, and then they went through a process to kind of create clusters or portfolios that were very effective at being competitive and setting market prices on a regular basis. And then when we went through this process with the multi-market model, and we looked at concepts of balancing markets, and so we moved away from the centralized pool process, where we brought in now a day-ahead market, a balancing mechanism. We did a lot of that work then. It all kind of was put into sort of like ice. It was like a cold reserve for the last 20 years, and now we brought it out again in October 2019. We started with the day-ahead market. We then also introduced sort of balancing. So we have internally within Eskom right now, we have a day-ahead market and a balancing mechanism. I can't say that necessarily we have a lot of competition, because most of the trading is taken place centrally and not done through the power stations as it was done then. But at least, the power stations have to give us every day what each generating unit, what its costs are, what its availability is like, and we then optimize the schedules. So it's kind of really just everyone getting used to the mechanisms. We have a balancing mechanism where we go and true up what actually happened versus what was scheduled. We've then built, so some of these vesting contracts that we talked about, we've also included those. So between the NTCSA and Eskom Holdings, there per power station, there is a sort of a PPA, which is really market participation being a cornerstone, a hedging agreement, as well as capacity payments and some of the issues around that, as well as ancillary services, which are covered per PPA with each of the generators. So it's kind of setting us up for the vesting contracts going into the future. And then distribution buys on those prices, but distribution pays for its energy that it requires on the day-ahead price. But we also then have a hedging agreement back to our sort of wholesale tariff, very similar structure to what this interim structure that I'm talking about here, we have between ourselves and distribution to kind of manage. So they're also getting some preparation, starting to prepare for being able to forecast on a daily basis what for each hour what they need to consume, and to take account as a balancing balance responsible party for that. So a lot of that we've developed internally. We did go out to the market for a standard offer, which allows for people to buy at those day-ahead prices. So we have a static price and a dynamic price, that they can sell to us under the dynamic price or the static price. And that price is then available for those generators. We also have an emergency generation program, which allows for some of the customers who have their own generation to offer that to us. And they then give us an availability and a price, and then we would schedule them. At the moment, most of those participants are doing it on a month ahead basis, but over time we hope to then move to sort of a more week ahead or day ahead basis, that they're also getting the sort of the learning of the day ahead market. So that's where we are now. Part of the process is if we aim for April 2026 as our starting point for the market, we might want to do some interim products. As I said, we've got the emergency gen, but also potentially allowing for some customers to buy at that price. As long as you've got the restructured and unbundled tariff, then maybe they can be exposed to those prices and can start being more demand responsive to see how they influence that price as well. But that's still something that we kind of have to work on as we get closer and closer to the full rollout of the market.
Okay, great. Yaku now's got a question. If I can just sort of summarize, it's sort of how do we get consumers to be able to interact with the markets? And I mean, bearing in mind that consumers of course have the most power to affect their demand during the day, day ahead and so on. And is there a way that consumers that would they sort of be interacting with the markets? I'm sorry, Yaku, I hope I've done your question justice.
Yeah, so the thinking there is that the qualifying criteria are not yet set for the market. In the market code workshops, we've kind of had a lot of discussion about the extent to which we go all the way to full retail competition, or do we keep it at like a wholesale level with certain qualifying customers and everyone else is sort of captured through the retail tariff. That's not 100% clear, but we're trying to build the market code to allow that at some point you might go for full retail competition. It's a lot more complicated with consumers being able to switch retailers. But the idea there that the retail product, to a large extent, would either, each retailer would have to set their prices based on, the best that they can offer, based on their contracts for differences, what's going on in the market. But in the absence of that, if those retailers can't set the right prices based on competitive outcomes, the regulator would then set a benchmark, against which I believe the retailers would be allowed to pass that on to customers. But even then, that benchmark would have to be related to what's going on in the wholesale. Otherwise, the retailers are exposed for those differences. And then there's a possibility that as part of those benchmarks, you can set price responsive kind of signals to show, peak tariffs versus on off-peak periods. And potentially even retailers might come up with mechanisms that they would offer their customers who can be price responsive, and be able to then use that in the market to influence the prices. So I think there is, as we get more and more into full competition, there's a lot of opportunity for retailers to be what's the kind of word, dynamic, and kind of looking at developing new products that would allow them to be able to carry that information back to the wholesale tariff, but also make a wholesale market, but make sure that their tariff to their customers are reflecting what's going on in the market in the long run as well. I see Kay's got
great.
Yeah.
Sorry, Kay, or Stephen as well. Kay, go ahead. Go.
Thanks. Yeah, sorry, I can't, as a participant, I can't type in the Q&A. Yeah, I just wanted more questions around how sort of long-term electricity planning will function as we transition to this wholesale electricity market. So who would have the responsibility for determining whether, future supply is going to match demand? And then in a capacity market, what are the sort of lengths of the contracts to incentivize new investment, particularly, as you say, dispatchable power or peaking power capacity?
Okay, so in terms of the IRP into the future, the way the ERA Amendment Bill is written is that it's still a responsibility of, what was the Minister of Mineral Resources and Energy and now Minister of Electricity and Energy, to do the long-term planning. But the important thing here is that the planning now becomes indicative as opposed to being prescriptive. Historically, IRPs were very prescriptive in terms of the regulator would not issue licenses unless you were in the IRP. And now, obviously, since licensing regime completely changed, that's kind of no longer an issue. But the idea is that we'd still do long-term planning. And our sort of intention as part of the NTCSA is that we would be supporting a lot of that long-term planning, still doing some of the modeling for the ministry, but also looking at, our responsibility is also to do the medium-term adequacy assessment, looking at the sort of 3 to 5 year window, as well as providing support for the longer-term window. But providing that information to the market to say, look, this is where we think demand is going. This is what we think is being built, or based on policy, the right kind of technology that is required for the system. And then kind of almost monitoring, is the market actually doing that? Is the market building the wind and the solar and the batteries and all those things that we sort of anticipate would be required? And if there's a shortfall, particularly if we consider that, for gas, you need long-term commitment, is to build the infrastructure and all that kind of stuff, that potentially then you signal the gap. And then at the moment, it's still the ministry. So Section 34 still provides, even under the ERA Amendment Bill, that the ministry can start a procurement process, whether that's done at the NTCSA level or at the IPP office level. That's still, it's an institutional thing that can be managed. But the idea is that would still be required in order to provide that sort of capacity. And so, yes, the IRP still is totally required. It's an important bit of information. And even in competitive markets around the world, people still do sort of IRP kind of plans to provide the information, and particularly also for your network expansion. You need a basis on which the network expansion can also be carried out, which would then provide signals for the network operators. I do think that when we look at the capacity market, if we have a proper functioning capacity market, you would really need to look at 10 to 15-year kind of windows for contracts to provide. I mean, as you and I well know, we've gone through this process around the risks, what happens with short term, that short term is not sufficient to provide the signals. But, it's possible that if you did 5-year contracts and everyone's then aware that there would be another round for capacity contracts thereafter, maybe that's not a problem. Maybe people are comfortable with 5-year transitions or 5-year blocks, but there's still that risk that you don't know what the rate is going to be for the second 5-year or the third 5-year window. By providing a 10-year, you provide a certain amount of certainty, and then obviously, if that's not sufficient, as we get more closer and closer to the time, you realize we need more, you can always go out for more under a shorter term. But yeah, at this stage, I do believe that it would need to be between 5 and 10 years to make sure that we get the capacity and provide that certainty to ensure that the capacity is built. Interesting thing about the capacity market is that we're thinking possibly you actually have a short-term signal and a long-term signal, that you can do short-term signals like daily almost of what the capacity constraint looks like. Do we need more capacity? Don't we need? So that you're rewarding people who have built the capacity if the system gets tighter or not. But you can also then go out on a longer term, kind of almost like a hedge, a capacity hedge that provides that long-term signal. So once those people are there, they have, you have the short-term signal and a variation around that signal that they would manage themselves. And it also allows that you can have renewables would be part of that process. It's not just about the backup supply, that a wind farm can actually count towards capacity if the wind's blowing at a time that the system finds itself that it needs it. And that would also be an interesting dynamic, that it's not just about what we historically see as dispatchable capacity, but generating capacity as a whole. And then you leave it up to the participants to take the risk that they would be there when the system needs them to be there.
Yeah, thanks so much.
Then one additional question from Stephen Lapson. Has there been any thinking yet about prudential requirements, just bearing in mind all those municipal distributors as counterparties and who kind of, don't always pay?
Yeah, I didn't go into the prudential requirements, but it's been a very touchy point as we're going through the market code workshops. It's absolutely a requirement that anybody participating in the market, so it's not for physical bilateral participants, but predominantly here we're talking about market participants. If you're going to buy on the market, it's a kind of a prepayment mechanism that there has to be cash up front. So there are a couple of options. One is that market participants can choose to provide a bank guarantee, they pay the money for the guarantee, they present the guarantee as their prudential requirement. And then as the market operator, we're always making sure that the guarantee covers their exposure, because every day when we're running the day ahead market, we can see what the prices are, what the market participant is paying or needs to pay, and we can manage that. And as long as it's always below the guarantee, then that's not a problem. But obviously sometimes you're going to have prices that are way out of kilter from what like the historic might have been, and maybe the guarantee is not sufficient, that you allow for market participants to top themselves up through almost like an escrow account or a trust account where they're depositing into it. And the idea there is that the account is in the name of the participant, that they can deposit into it, they earn the interest on it, but the market operator controls who can access that money. So the idea then is that if the top-ups are required, you can use that account. You might even find some market participants, particularly smaller ones who don't want to go through the stress of a guarantee, just use the top-up mechanism. So they, on a regular basis, are watching to see what are they procuring, and they just make sure that the cash is there in the escrow account. And then at the end of the month, when we do the bills, we're able to draw on that money and then kind of start the next month's process. So yes, prudential requirements is a crucial component of this. It then begs the question, how will municipalities participate if they can't even pay the bill after the fact? And that it's a great one that kind of is on everyone's mind at the moment. If we want the market to be effective, we have to have an answer for this. And it's going to be a long-term kind of issue to try and resolve it. It might mean that when the market opens, we only have Eskom distribution and large power users and none of the municipalities involved because of this issue. We've raised it as a possibility that government look at the concept of a special trader that would basically be backed by National Treasury and trading on behalf of the municipalities that can't trade for themselves. because the worst outcome would be leaving all the non-paying municipalities with distribution, and it has no cash with which it can actually pay for in the market. So it is something that it's a very serious issue, quite a complicated one, but I can't say we have an answer. It's just definitely one of the things that has to be resolved as part of the process moving into the market.
Okay, great. I think we are officially running out of time. We do have one last question, but maybe, Ruz, you could take that up with Keith offline. Kay, did you want to close?
No, you are welcome to. I didn't really
Okay.
introduce Ryan. He's also a council member at the SAAEE, or the SAAEE. It's a very difficult acronym. So yeah, I'll leave it to you to close, Ryan.
Okay, great. Well, thank you very, very much, Keith, for a fantastic presentation and very interesting insights. And thanks for everybody who participated and for the great questions and the interaction. I don't know if you want to say any last words, Keith.
Again, no, thanks for your time. It was great to have the discussion. And hopefully, if you haven't already, you can join into the market code workshops. There are 3 remaining in our current set. Otherwise, go to the NTCSA website where you can actually see the recordings of the previous workshops. Thanks.
Great.
Great.
Thanks, everybody.
Great. Cheers.